a lot of people just a few months ago had not seen this coming. Luckily for us today, we have a market guest that did see this coming. I want to bring on, to start the show, Fundstrat Global Advisors Tom Lee joins us right now. And when we look at this, Tom, it's hard to say you've been right for so long, but I'm going to highlight some things that you've been right about. Keep in mind, back when we were in free fall, back in March, when the S&P was at 2260, Tom said that we would see a snap back to 2,800 by April. That was right. When he said that we had crossed, recovering about 50% of the losses that we saw since February, that the gains would only accelerate just like we saw back in 2009. That was right. And now, Tom, you're calling for a return to all-time highs. And as we sit pretty close to those, it looks like that is the momentum right now. But I want to start in terms of, if you were so contrarian to get to this point, with the jobs number right now, I'm wondering if you might be a little bit contrarian in your thinking now, because this jobs report blowing away expectations, does that possibly maybe get the Fed and, congressmen and women right now thinking that there is no need for an additional wave of stimulus? What do you say about the jobs number we got today?
Yeah, Zach, that's a good point. Good news is good news until it's bad news. I think Congress is still dealing with the fact that we have record unemployment. And so even if it's a beat, and it was really a shocking beat for the May payrolls, I think phase 4 still has a lot of support, because at the end of the day, we know millions of Americans aren't working. And the Fed similarly, with their Main Street program, and the idea that the consequences of maybe overshooting aren't as bad as really undershooting. And we saw what happened in December when the Fed moves, kind of too much in the wrong direction. So I think stocks are still good risk rewards here, despite the May beat and maybe the move this past week.
Well, let's talk a little bit more of that risk reward, right? Because as I said, when we crossed the 50% retracement line, you had pointed out that most of the recoveries that we've seen in the past have indicated that is an all clear signal. Now, as we move past the 76% retracement line, what does that say about the recovery here to get to all-time highs? How sure are you that this insane step higher that we've seen over the last few weeks will be continued and not necessarily see I guess what I'm asking is, what's the propensity in your mind for maybe a short-term pullback here?
I think a pullback, I'd love to see a pullback, because I know that people would rather see a market that is two-way, one that, pulls back on dips so that it doesn't feel unforgiving, but there's so much money on the sidelines. There's $5 trillion of money market, $2 trillion of private equity cash. Corporates raising another $1 trillion. You have $8 trillion that's flying into corporate equities. And I know that in our many conversations with our clients this past week, I would say about half are still uncertain on the sidelines, because the market has moved with such vigor, but the economic data, maybe with the exception of today, has really just been muddling. And I think maybe today will be a call to action, actually, to get some of the money off the sidelines.
Well, I guess, the pushback is pretty sound when we think about the trend turning here for sure. And the surprise of the jobs number we got today, still very impressive when you think about how the trend has been, just terrible economic data getting worse and worse. But still, by historical standards, we're still not sitting in a strong economic position when you look at the fact that we still have lost 42 million jobs over the last 10 weeks. And you think about how much of that is here now. The fact that we recovered to this point, long term, how is that going to play out when you think about what happens when you get to the end of the year and you still are sitting at what economists are expecting to be a 10% unemployment rate, which was the worst of the 08-09 recession?
Yeah, it's tragedy. Part of the reality is that 75% of the S&P's market cap are bond proxies. They're defensive or secular growth. They don't move with the economy. That 25%, the epicenter stocks, have been destroyed because of everything you've described. I think it's going to be really important, whether it's policy or business strategy, or just pure empathy. Everybody wants America to get back to work. I'd love to see it. the more confident consumers are and consumer confidence is held up, the more they're likely going to venture out. And Gordon Haskett had a great survey this past week that showed there's a huge increase in people's willingness to step out. So I think the stock market's telling us that the recovery is going to be quite vigorous. And I think that's maybe the positive message I'd say is that the stocks aren't moving ahead aren't disconnecting from fundamentals. They're telling us fundamentals might come back really strong.
All right, well, let's talk about some of those opportunities, because you talk about the epicenter stocks. You highlighted that last time we chatted that some of these opportunities were there for some of the stocks that had been the most beaten down, mainly airlines, casino stocks, restaurants included. When you're looking at some of those names, I understand the surge in American Airlines and saying that they're going to see, recover 50% of its domestic schedule in July. That's up from 20% versus last year, what they had expected in terms of recovering that schedule in the month of May. But we've seen American Airlines up 66% in the last 2 days. So are you still saying there's opportunity in some of these hard-hit names as they've already started to be some of the strongest recovery stocks? Or are you saying maybe take a breather on those and wait for a little pullback and then jump in?
Zach, we published a list this morning for our clients, and and 17 ideas. Like myself, Rob Slimer, our head of technical strategy, and Brian Rasher, our head of global portfolio strategy, really sat down and we came up with 17 stocks that I think are early in the recovery. That includes some of the casinos like Wynn. It's Carnival Cruise Lines. Even though it's bounced, it is still many floors below ground level. And the airlines have definitely moved a little faster. So things like General Dynamics and Snap-on might be better, derivative plays, and TJX on the retailer side. So I think there's still tons of opportunity. And again, I think that's where the dry powder is going to go. It's going to seek cyclically sensitive stocks, and those things in 2008 had massive operating leverage. I mean, that's why one thing that we have to keep in mind, if this is the worst economic recession in our lifetime, in the country's lifetime, and if cyclicals don't die, they're unkillable. These things survived like the apocalypse, and therefore their multiple should be going up huge. So I think the cyclicals are going to rally big.
Well, I'm glad at least you tempered your call there on airlines. I was about to pounce and highlight a few things there, but pointing out some other derivatives that might be better plays. I mean, I'll just hit the point again, just because we talk about the surge in that. You can look at jets. I mean, that's a good example in terms of the inflows there, as Bloomberg highlighted, 64 consecutive days of inflows it reached earlier this week. Assets up there, it used to have 33 million, now up close to $1 billion. Even the CEO of that ETF said that bored millennial day traders were the reason for that rally. And he said it'd be a joke if it weren't backed up by statistics that we've seen on the Robinhood trading platform. So, I mean, when you look at the reaction here, and you can look at the highlighting the data from CBOE saying that stock traders are back to making their most bullish bets since 2011. I mean, when you put these pieces together, I understand that statistically the data would show that this recovery is playing out as you would expect from market collapses. But still, when you put all the pieces together, is there not a piece of you saying that, okay, maybe this is starting to shift into more speculative bubble territory?
Oh, yes. There's a lot of speculation. And as you know, most stocks end up, that are speculation end up, disappointing people. You don't really want to buy hope. But as I said, I think a lot of cyclical names that have been completely bombed out, that are real companies, are going to come back really strong. I mean, I think Wynn's an example. Wynn is not going to be replaced by a competitor despite getting obliterated through March.
Yeah, no, I mean, it's a good point. But even in that name, we've been highlighting a couple of Vegas guests this week, noting that things there might not return to normal till 2023. Yet we've seen an incredible rally in those shares over the last couple of weeks. So I guess the main point would be, they would say that this would take until 2023, but you're saying that there's still opportunities here for a long-term investor looking for the hardest hit names, and there's still money on the sidelines. And yet, when you look at all of this, there's still the looming pandemic out there that no one seems to want to talk about. I know you're not a health expert, but you've at least conceded the point that maybe there could be a second wave here that would kind of undo a lot of what we're seeing. But it seems like the market right now is pegging the chance of that to about 0%.
Yeah. Actually, Zach, I agree with you. First of all, we've got so many protests across the country. Those are all super spreader events. That's why Northern Italy and Spain got hit so hard was the Champions League soccer match. I mean, this is that times 10,000. So we have super spreader events taking place everywhere in the country. So by June 11th, we'll know. But something to keep in mind, if the market's not oblivious to this, the epicenter stocks would be cratering if there was incremental risk. And, county by county, we are tracking it. So I think the fact that they're holding up is actually ironically telling us there probably isn't a second wave. So I'm, again, letting the market sort of tell us what I think is happening. And I think a vigorous recovery is happening. And maybe the second wave risk is really diminished.
All right, well, we'll be keeping our eyes on that, keeping our eyes on the market. As always, Tom Lee, you've been right up until this point. We'll see what happens on the all-time highs call. Fundstrat Global Advisors Managing Partner. Appreciate you taking the time.
Great, thanks.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.